Hey, best ever listeners, welcome back to Unlimited Capital. Today I had a guest, Bruce Stein, who is an incredibly accomplished real estate investor and now actually helps investors with real estate portfolio management from a financial planning and asset protection and succession planning. And that this is going to be a little different than other episodes of Unlimited Capital because, as you guys may know, Property Llama, which is my main company, it's all built around a real estate portfolio analysis and portfolio management, like from a financial planning point of view, not asset management. So this is a topic that is actually near and dear to my heart. And I know that a lot of people who listen to this show directly own real estate. And here's the fact of the matter. Real estate is not a set it and forget it game if your goal is maximizing returns. There's also planning succession in a real estate portfolio is a very serious undertaking because when you are getting on an age and you have your heirs, the vast majority of people are not cut out to directly own real estate. And that is a very, very serious topic that can have disastrous consequences for your heirs. I mean, because everybody says buying, you talk to any broker and they'll tell you that the best deals are, apartment buildings that some siblings inherited and then ran into the ground after the courses of 6 years. And then a value add guy gets to buy it off them and rehab it. But this guy has also raised $300 million in capital. I mean, crazy, right? So the second half of the show, we talked a lot about institutional capital raising. So overall, this is going to be a great episode. It was a tremendous pleasure to interview Bruce, and I hope you all enjoy the show. And before we get going, as a reminder, Best Ever Conference is having its 10th year, and it is going to be better than ever. As always, it's going to be in Salt Lake City. I will be there teaching my What's Working in Capital Raising in 2026 workshop. You can come meet me. That workshop is for VIP ticket holders only, so make sure you get a VIP ticket holder if you want to hear what's working in capital raising. I'm going to be talking about the tactics that are working, which asset classes are selling well and which aren't. Go to besteverconference.com, use code podcast10, all caps for your ticket. And with that said, a word from our sponsor before we go to the interview. Hey, Bruce, welcome to Unlimited Capital.
Hello, Richard. Thank you for having me join you today.
Yeah, it's a great pleasure to have someone as accomplished as you and with such a strong track record in real estate. So why don't you help by telling the audience a bit about your story and where we are today?
Well, it all began, I think, the long story short is when I was 5 years old, I wanted to be an architect. And so I was very fascinated with architecture. I took drafting classes in high school. I worked for an apartment developer. And then attending college, I thought I really wanted to be an architect. But I also got a job as an architectural coordinator and realized I really liked the development side better than the architectural side. When I graduated, I moved to California and I was able to get lucky and I started working for a real estate syndicator. So I got to learn a little bit about capital raising, how do you go underwrite properties, asset management, financing. And after a few years, I tried to do that on my own and I found I could find a real estate, but I was not really good at capital raising. So then I decided to go work for a family office that I didn't have to worry too much about capital raising because I had them as the background. And then I worked for them for 16 years. I raised $300 million funds for real estate, was developing real estate around the country and buying hotels, building homes. And then I worked my way out of a job there because the patriarch passed away and the children didn't want the real estate. So we had to sell it. And this was in 2010. I started working for a private debt fund doing bridge construction financing nationwide. And 18 months ago, I realized it was very, very competitive. And I decided I'm just going to go off on my own and do consulting. So I'm primarily working with real estate investors. I help them look at their portfolio, figure out what they should buy, sell, hold, refinance. And with the older investors, I also help them figure out exit plans or succession plans, just because their beneficiaries really probably don't know much about real estate. So I try to look at it from a full perspective.
That's very cool because I don't know if you know this, but I have a software company called Property Llama, which helps people manage their real estate portfolios. I think probably smaller than you because you're probably like kind of sub family office type, like large holdings. I mean, I usually work with people who have, like 3 to 5 rentals and stuff like that. That's our avatar. But one of the things you said that really hit me was that real estate is so hard to pass down. Like we hear that all the time.
Yeah. Yeah. The owner understands the property, and most of the time they know everything, but their heirs don't. And that's where the complication comes. So a lot of times I'm going to work with them and make sure, first of all, how you holding title? Is it in your name? Is it your family trust name? Is it something that's easily transferable? So I'm always trying to just educate now more than anything at this point. And I also do like working with young investors who want to start building their net worth through real estate, and try to give them some guidelines on what I would be doing if I were in their shoes now.
So what are those guidelines? Yeah. What tell me about those people.
So if you're starting out in real estate, to me, it's first of all, stay in your backyard. So it's easy to get to your properties. I don't think if you've got to travel outside the state or outside the city, you become really an absentee landlord. You become definitely more prone to having to deal with third-party management, even though you may need a third-party manager depending on the type of property, but make it simpler. Make it where you can visit the property on a regular basis. You don't need to make an appointment. You just show up. When I was doing my syndications, we were going out of state, and because we could buy more apartments than we could in California, but I would have to travel every couple months, and you tell the manager, oh, I'm coming out, and they make sure everything looks good. If you show up unexpected, the place may not be as clean. Maybe a unit that's really occupied that they say was rented or not rented and things like that. So stay local for a while. Pick one type of property, whether it's apartments or retail. Get to understand the specifics of that. And then once you build that track record, then you can then start reaching out to people other than friends and family and say, hey, I want to buy this property. Here's my track record. Here's my focus. Here's what I've done in the past. And you can easily identify what your track record is. But if you're going around the country, unless you're a couple $100 million fund, you can't really diversify. You really want to stay as focused as you can. My first recommendation to anybody starting out in real estate, stay focused.
Yeah, I had a similar learning like that because I live in Denver, and then I decided to purchase in Colorado Springs, which is, only about, like, depending on traffic, 60 to 90 minutes south. And trust me, I thought that I was like, I didn't want to go out of state for all the reasons you're saying. And even having to drive 90 minutes down to Colorado Springs is an enormous amount of friction. You know what I mean? Because I'm a busy guy. Like I've got I don't have a W-2, but I work full time, and my full time income is not operating my rental properties. So I really agree with that.
Yeah. So, matter of fact, Colorado Springs is one of the first properties we bought an apartment building because we picked the wrong manager, because we didn't know better, and just the property wasn't maintained as well. And when we sold the property, we found out that our rents were a little under market, but we were relying on that third-party manager because we did not have the depth of knowledge of that local market if we had lived there. Now, always trying to pass along the mistakes I've learned to new investors.
Yeah, no, definitely. So one of the topics that you submitted here is a topic that is near and dear to my heart. Because I guess on this episode, we're definitely talking less about capital raising, at least for the moment, and more about kind of real estate portfolio management. And by that, I mean like from the financial planning point of view, which, like I said, I have a real estate financial planning software tool. And so one of the topics you talk about is when is the best time to sell my property?
Yeah.
Now, before you get into that, we're going to have a word from our sponsors really quick. The
Okay.
people who keep the lights on over here and pay for our producer and the distribution of this podcast. So right after that, we're going to hear when is the best time to sell your property. Okay, we're back. So here's the big reveal. Like, what is your framework for figuring out the best time to sell your property?
It's a lot of times I always look at it as looking at your portfolio and saying, is there some magic point where you can maximize profit on a particular property? So it's like, when is the market favorable? Sometimes, you have to sell because you need the cash, but, understanding market conditions, is going to play a huge role in determining when you're going to sell a property. Obviously, everybody wants to, buy low, sell high, but, you've got to be able to understand the supply and the demand. Is it to your advantage? When is that particular type of property? So if you've got a 16-unit apartment building, is this a good time? Are your rents at a point where there's still some upside? So I'm always telling people, first of all, if you've got a property and you can show the buyer there's a little bit of upside, maybe that's also a good time to sell. But a lot of times, a lot of my clients, they just need cash and they've got to decide, regardless, I just got to sell my property regardless of where the market is. It may be that the maturity of the loan is coming due and they just cannot refinance the property. They cannot come up with extra equity. So they're being forced to sell a property just because they don't have the cash to reinvest into that particular property. And obviously, to me, you got to be looking at what your goal is in the long run. Are you really want to be management intense, or are you now looking to really just have it where it's easier to manage? Maybe taking a 16-unit apartment building, selling that, do a 1031 exchange, and maybe find an absolute triple net property with one tenant with a 20-year lease. So you got to start asking yourself, how much work do I want to get the cash flow? And so I'm always looking at it as, what can I find that will provide the same cash as what I'm getting right now and not have to work as hard? Because, you want to be able to use your equity to your best advantage. And sometimes just getting rid of a property management headache and getting into something you can then focus on other properties. So that's part of what I would look at if you've got 3 or 4 properties, look at which one is causing you the biggest headache. Look and see, is this a good time to sell that property? And then choose to sell that property over any others, and then start doing the same process over and over again. People fall in love with the real estate, but I think they forget that the value is in timing when you should sell and finding something that's easier to manage. I just think if you're an individual investor, you should not be spending 60 hours a week managing your assets. You should be spending 60 hours a week looking at what my next investment is and how do I keep improving the value of my portfolio.
So 2 things that I want to hit on there. Number 1, what you were saying about what's your biggest headache property, that is like the second question in our portfolio analysis script. We have obviously we've done hundreds, if not like thousands of portfolio analysis sessions with our users and clients and everything. I mean, because my partner, Chris, was doing this portfolio analysis even before we built the software. In fact, we built the software around his portfolio analysis process. And that we always get into like the second question is always, okay, so you've got all these properties here. Which is the one that you don't like? Like what? And that people are just always immediately like, that one. Like, I hate this one.
Yeah.
Because it's like, it's just some attract bad luck. I mean, you don't know what it is. Like, oh, this is the one that always has tenant problems. This is the one that always has maintenance problems.
And typically what I find is, my clients, they don't want to pay capital gains. So they're always doing a 1031 exchange. And what I find is they've used a broker to sell their property and probably was the right broker, but then use them to find the replacement property. And I really think that if you're looking for what I call an absolute triple net property, you should be using a broker that specializes in that because they know where they're at. But all too often, I think what also happens is you look at and go, oh, I'm selling a property at a 4 cap and I could buy this property at a 5 cap. What can go wrong? And then you find out, well, this is why, you're paying a 5 cap maybe for a property is because you're going to have constant tenant turnover or the age of the property. And now you're having to do all the deep renovations that have to be done and just to maintain the property, but has no value to a tenant. But you got to replace the air conditioners, the roof, the landscaping is tired. So you're throwing a lot of money, but it's not helping the tenant. And so you're going to have a lot of tenant turnover because you're not putting the money into their space,
So I think something that you're trying to get at here, and you can correct me, your kind of thesis is that even if you're going from like 2 identical NOIs, or like, let's say an identical amount of NOI for your equity, that one of the things you're just optimizing for is better quality of life.
Yes.
And that's a huge win. That if you can go from like a 5 cap and call it $4,000 a month, that would be a lot of cash flow. That would be a huge building. But let's say you're going from $4,000 a month in cash flow into another building that's still only $4,000 a month in cash flow, but you're going from like self-managing a 16-unit apartment building to a triple net, that's a huge win in your building.
That to me is a huge win. Yes.
I mean,
why? Yeah. I think you minimize life is too short. And
yes,
there are people who love that, but they don't realize that if something happens, you could break a leg. And if you're not going into the office, who's now calling the manager and saying, is the space leased? What's the rent? What do we do about this? It's like so many questions that you've got to be constantly asking. And if you're, a small company, you've got to be spending a lot of your time on just little day-to-day things. So it's like, I'm always trying to focus people, try to make your real estate portfolio simpler. Let it work for you, but take your time and then use that time to figure out what my next property is going to be.
Yeah. Another thing that you said was about how it's really about market conditions when you buy and sell. And actually, I just read the book. I don't know if you've read it. It was called King of Capital. It's about the founding of Blackstone and Henry Schwartzman and everything like that. What's funny is that at the end of the book, and that he has 2 books. So there's his autobiography, which is, oh God, this is embarrassing. Cannot remember the name, but he's got his autobiography, Whatever It Takes, is what it's called. And then there's King of Capital. So King of Capital took place basically right after the IPO. So it's an earlier book. And the thing is that King of Capital is also like a journalistic biography as opposed to, an autobiography, which is, of course, makes everything sound great. And it's like, here's what I really learned. It's all about family at the end of the day. No. This is like the story of the business is King of Capital. I think it's a superior book about studying Blackstone. And the reason that I bring this all up is that it became apparent like halfway through reading it, because they talk about like not every deal that the firm ever did, but a lot of them, and especially the major deals that they did. Versus, his autobiography is very light on the details of individual deals. And that it became clear to me halfway through, and then was explicitly stated in kind of the summary at the end, that market timing was responsible for just the vast majority of the returns, which is kind of a frustrating thing, because the counterpoint to that is everyone says you can't time the market. But that it became clear to me in that book that every time Blackstone got into a bidding war over an asset and then won that bid, it was a bad deal. And that like the only reason that they not the only reason, but a major reason, and they quantified like the component of the return that was like multiple expansion or like buying intentionally cyclical businesses at the bottoms and tops of cycles. And they said that it was really like cyclical timing was responsible for, and like, don't quote me, but like 70% of the return. And then operational improvements or transformation was only 30%. And so I wonder, A, have you read the book? And if you have not, what do you think of this kind of parallel that I'm making here?
No, I have not read the book, but I am familiar with Blackstone. And
of course,
part of, they're able to attract money at a cost that we cannot buy. So,
Yes.
their cost of capital is a lot less money than they got buying power for one. I followed them when they were getting into hotels and they were buying portfolios. And I remember there was a comment saying, yo, we're buying we could care less about if every Hilton hotel is actually doing well. Because if we buy, 100 of them, all we really care about is there 20 or 25 that are underperforming. And if we can then create a little magic with those properties, improve those, that's going to more than outperform the other 75%. So I think they were always looking at, I got to buy a whole bunch of stuff and maybe I can sell some of these. They did that with industrial properties, with
Well,
office
and equity
buildings.
office,
Yeah.
EOP. Yeah, they did.
Yeah. They
Yeah.
would buy a huge
Yeah.
part and then they would sell off what they just thought there's no upside to. So to them, it was timing on when they acquired the property. And I don't think they cared if they overbid because they saw that their properties were worth more if you could break them up, and they could obviously hold them for a little bit longer than maybe you and I could because their financing is better, their equity doesn't require as much. So obviously when you're a behemoth like them, you could pretty much dictate what they're doing. But as a small investor, yeah, you can't do that. You're hoping you timed it right. And then you're hoping in 5 years. The problem is in 5 years, maybe your loan matures and now
Yeah.
the timing isn't right, but it should be a time that you don't want to sell. And now there's external forces causing you. If you have a lot of equity, you could just pay down the loan in cash. And, Blackstone could do that if they have to.
Well, or they can stay in it. Like a lot of their worst deals, like they took them 20 years to get out.
Yes.
Because they had the staying power and then didn't break even or lost a like very small amount of money, but that they still had to like stay in it for 20 years. But I think like what they managed to do, and I think it comes back to like whether or not it's even possible for either a retail investor or a sub-institutional syndicator, is that it seemed that like a lot of their success was around funds raised in booming times, but then deployed after the boom had collapsed. And that they hadn't been through that many cycles because the cycles are so long. There were only like 3 or 4 cycles like up to this day, and that they began in the very early 80s or like the mid 80s approximately. And they've only been through 3 or 4 cycles, and that it was always like the funds that they had raised like in the mid 90s, which was a major fund, or a major fund that they raised in like 05, 06. And then it was not that they had deployed that in 05, 06. They, in fact, like, 506, they were very smart and that they did some deals that they overpaid for and didn't work out, but that the vast majority of the capital they held on to because they had discipline and they weren't going to buy these businesses in like crazy bidding wars. There was like a lot of telco deals they were doing back then. And then basically like everything crashed and then they deployed all the money. And so it was like, I kind of like, how do you generalize that to a normal person? Because like, we don't have the ability, like it's super hard to raise a massive blind pool fund, right?
Yes.
And then just say, I'm going to sit on this for 3 years or like wait for a crash and then buy everything.
Unfortunately, when you're putting together a small syndication and you're telling people 3 to 5 years, and then they're saying, okay, 5 years, I want my money back. And you're saying, well, this isn't the time. But if you have a fund, you could turn around and say, well, no, the life expectancy is 5 to 10 years. And I remember in 2004, we raised a $100 million fund to buy hotels. And we started buying hotels in 2005, 2006. And then we're starting to see in 2007, things just, we did not know what was going to happen in 2008. But we just saw that there was just people were coming to us and say, can we buy your hotel for more money than we would ever imagine? When we sold them. But then we couldn't find
you have
properties, and we had to. And then we couldn't find replacement properties. And we went back to our investors and say, we're just not going to deploy the money. let's sit on this and see what happens. And then 08, 09 came, and we're looking at it and saying, okay, now the hotel market is completely upside down. Do we want to buy? And we allowed our investors to make that decision. And they just said, if you don't mind, we had a good run for a few years. Let's just closed down the fund, and we had one property left. We ended up selling it for a small loss, but that was what the investors wanted. So if you can't have that relationship with your investors, you're, first of all, you've got a problem. So that's another thing that I would always say. If you're, whoever you're getting your money from, you got to have a very good relationship with them. You should be upfront with communicating with them, because I've known so many people who try to keep the bad from having to tell your investors something bad. And that's worse. I'd rather come out and tell somebody we had a problem. We lost a major tenant we did not expect, or this has happened. But if you try to not disclose that early enough, I think your investors then just lose a lot of faith in you, that they don't come back and saying, let's do this. That was the one thing I've learned is, you treat your investors as like the
Uh-huh.
family, keep them, that they're, because we could have made more money managing the fund, getting fees, and we didn't think that was the
Yes.
right thing to be doing. And so it's like, you got to put aside, I'm making a lot of money managing the hotel fund or this fund or this fund, but it's not right for the investors. And you got to make a choice of, reputation. I mean, and that's something else, whether you're a little investor or a huge investor, your reputation is the most important thing you've got to protect.
Well, and not just that. I mean, a phrase that I often use is that trust is gained in ounces and lost in pounds.
Yeah.
Yeah. And that I think what brought that to mind was your comment about hiding bad news, and that also because I came from a consulting background and hey, we're going to be late. Like you don't tell the client like, oh, we're doing our delivery on, the 15th. You do not tell the client on the 15th that you're not going to make the 15th.
Yeah. Yeah.
Yeah. You tell them that on the 10th and
It-
say,
or
here's
you,
what we're doing to take care of it. And that a client will love that. I mean, they love that. I mean, sure, there's a point where if you do it over and over again, they come back to you and they say, okay, we got to stop being late. But that when you guide them towards, okay, we're not delivering on the 15th, we think it's the 19th. And then you give daily updates as you either try and close the gap, like that is the way to do it.
I always say it's manage expectations.
Yes.
It's like, I know I have certain expectations, and if they're not met, I get upset. It is, and then I have to look at it as a client, I'm trying to manage their expectations too. What do you want? What do we have to do? How do you get from A to B? How quickly do you think you can get there? And people always want to get there quicker, or they're thinking, oh, I could sell my property in 2 years. And you're saying, well, no, this is going to be a 3 or 4 year process if you want to double your money. It's, it's not as easy as everybody thinks it is. And I think that's where I think people read about all these people who make so much money in real estate and they don't realize they were doing it for a long time, and they bought something that was not on the market, a friendly transaction that everybody was very happy with. And, that's what I'm always telling people. I'm in a networking group, and I always tell people, talk with everybody, and ask them, do they know anybody? If you're trying to buy real estate, just always, ask at a cocktail party, hey, you own real estate. Are you happy with something? Do you think you want to sell it? I know somebody who may want to buy it. And then, next thing you know, it's like there's no brokers involved, and it's just get two people and say, okay, here's what I need. Here, okay, here's what I can do. And I find sometimes it's those quiet transactions that are the most profitable ones for both parties, actually.
Yeah. I mean, well, anytime you can avoid a full marketing process. I
Oh,
was about
yeah.
to bring it back to like another. I also just read the KKR book, Barbarians at the Gate. And it's funny, like who really won there was the RJR Nabisco shareholders, like
Yeah.
big time. Everybody else lost big time. And Russ Johnson got 50 million bucks. So
Nope.
good for him.
Good
But
for,
yes, avoid a bidding war at all costs.
yeah.
Unless you're the seller, of course, where you should be trying to generate a bidding war at all costs. Um, but I wanted to pivot this conversation a little bit because you have raised a lot of capital, and this is a
Yeah.
capital raising show. And so I cannot, as I have a duty to my listeners to hear from someone who has raised an enormous amount of capital, to get some tips here. But before that, we have another word from our sponsors. Okay, Bruce, like tell us about the types of capital you raised, first of all. Like who were they from? Because you said it was $100 million. So tell me about the deal. Tell me about what it took.
I raised three $100 million funds.
Oh,
So the
pardon me.
first one was we were working with banks to invest in low, moderate income properties where you can get tax benefits by investing in it. And back in the late 90s, banks did not have a lot of those type of credits, and they needed to be able to get them. So we looked at it as here, we can invest in this property and you can get your credits because it's low income.
Mm-hmm.
So it was mostly banks. We then started looking at and saying, okay, now let's maybe do some more development. And there we started attracting, and we went out to like a lot of the funds. I mean, like pension funds.
Uh-huh.
And they were interested. The hard part is raising $100 million fund. We had to go to small pension funds because if we went to like CalPERS, they wanted a minimum of $25 million, but they only wanted to be 5% of the fund.
Mm-hmm.
But that means you had to be like a $500 million fund. We did not want to be that large. So you have to, first of all, kind of identify, okay, how much do you want? Is it going to be $5 million, $10 million? And then you got to then look at who kind of. And the second fund, we actually had somebody help us raise the capital. So we went out to get a third party and paid them a small fee to go out. And they were then introducing us. That was a road show. That was really exhausting. It was like 9 months going back and forth. We went to, had to go to New York a bunch of times, but we ended up getting a number of larger pension funds, but believed in it. But they would come in with $10 million. And part of it is they wanted to invest with us because we had that track record of showing we knew how to manage a fund. We actually were able to go out and invest the money really quickly. We had a couple good exits. So they were saying, I'll take a chance. And with $10 million and being 10%, they were fine with that. So that was important, is understand who could be in it. And then in our third fund, which was a hotel fund, we went to lenders, we went to title companies, we went to labor companies, and we said, if we buy a hotel, we will not oppose if the hotels want to be union. So we had a lot of union money. And and they were saying we would card check neutrality. If the workers want to go in and form a union, we're not going to oppose it. But we also knew that if you treat an employee well, there's no reason for them to want to unionize. And we kind of knew that. So we made sure our manager was well, could manage the employees well, treat them well. And it's like we would hear other people who were managing hotels, they would have like their housekeepers clean 10 rooms a day. We would limit it to 7 or 8. We wanted them to come to work because they wanted to be there and they earned a fair living. And we knew that if we did that, the chances of them becoming union, but we got all union money just because we said we would, if they wanted to be unionized, they would. And they thought, oh, we were going to generate all these union jobs. So we had like service employee union, we had the laborers union, we had carpenters union, we had, and they all thought, oh, we're creating all these union jobs. Didn't create one. But it was, again, managing their expectations and why they should invest with us. And then on the hotel side, managing our employees' expectations so that they wouldn't want to unionize. So, it's trying to learn both sides because So that was helpful. And we were able to raise that fund in about 3 months. So it was
Wow,
quick.
that's shocking.
And we had a lender who, but they put up a lot of money, so they had first right of getting the loans, and they invested 10 million, but they got about $100 million in loans because but they had but they just had the first right and they can match somebody else's terms. And they wanted hotel loans at that time. So and we disclosed that to all the other investors, just like all the other investors were saying, go create union jobs. We're saying they may get money. So you have to make sure you're explaining it to every investor. The one thing we had to do is, got a mental block on what it's called, but we had a side agreements with everybody that we would not offer somebody more favorable terms than somebody else. So if somebody came in and said, we'll give you 25 million, but we want a 10% preferred return and we were offering 8, we would have to then offer that to everybody. We wanted to make sure that we were treating every investor the same, and early
Yeah.
investors should be treated with the most respect and protect them. And if you're trying to get that last few dollars and they're coming in saying, well, okay, you want my money, I want to better the terms for myself, you have to sometimes say no to that, or you got to then go back to everybody else and saying, hey, we want to close out the fund at 100 million. Guess what? Instead of 6% preferred return, you're getting a 7.5. Thank you. But this is, because you don't want to ever have somebody find out that somebody's got more favorable terms than you have. And that's where I
Yeah.
think
And
that,
also, I'm a big believer in transparency around side letters and share classes. I would say especially because there is legislation that's starting to encroach on that topic. Like it doesn't overtly say that all side letters have to be public yet.
yeah,
However, I still think that that's good policy, but it is starting to say that if you have a side letter that negatively impacts other investors, now you do have to disclose that.
yes,
But I think that's enough of that. One thing, an insight that you pulled out that I'm a huge believer in because I've raised money for a variety of projects and asset classes is that, you know, if you have an investment that solves a very specific problem or objective for an investor, you will have dramatically higher success than like a 17 IRR. Let's say that suffices the investor's appetite. Let's say it's 17 IRR. But that if you have an investor who like wants tax benefits, like you talked about for the bank, like low income housing tax credits, or if you have, I'm a big fan of debt funds because my typical landlord profile really wants cash flow. And so
yeah,
if I can say that like a pure cash vehicle is a really great fit for you, or oh, you really need depreciation, I always find that it goes dramatically better when you're able to find like a very specific problem that they have or a very specific objective and then match like a puzzle piece, easy metaphor to understand, the benefits of your specific investment that you are trying to like sell or fundraise for, you'll have a dramatically better time.
yeah. And I think that's the problem. I think that a lot of, younger investors still have is they're stuck on cap rates. Yeah, and sometimes cap rates do not tell the same story. And I would argue I'd rather get maybe a 4% cap rate in a very landlord friendly state
Mhm,
than a 5% cap rate in a tenant friendly state. So I'm kind of talking about what I'm seeing in California with apartments. It is
mhm,
so difficult now to be an apartment landlord. And so if you're
mhm.
buying a property and you're getting 5% cap rate, you're looking at just losing control of managing your property. Whereas if you go to a friendlier state, Texas, or, I think Colorado's still a little bit that way, Florida,
No,
you,
it's sliding fast.
it's flying fast.
Yeah.
But, it's where, again, trying to figure out what that key component is. But, I know people who just say, I just want a property that if I get the 17% IRR, if you can show them that, I think you've made your life simpler. The problem is, are they agnostic to what type of real estate they're buying? So, a lot of my clients just own so many different types of property because again, they're looking at, I want to double my money in 4 years. So it's got to be like a
Mhm.
25% return IRR. And there's only so many kind of properties. And so they're focused on that and not really what property they're really buying. They don't care. They just looking at it as
Well,
just, and, and I'm always
and I
saying,
think,
don't just look at that. Look at lifestyle. I'm always going back to look at the lifestyle that you want. The
well, and I also think another point is like, look at the downside risk. You know what I mean? Because you can have like not losing money. I mean, that's like the oldest Buffettism,
yeah,
in the world for like a very good reason, and that, like you said, you can get a five cap or a 17 IRR or pick your metric and two deals that have dramatically lower risk tolerance or dramatically different risk tolerance. And I would personally take, I don't want to use hard numbers, but like I would take a 40% discount on return on something that's 90% less likely to go to zero all day.
yeah,
Like, especially if it's like my portfolio, you know what I mean? And not like, oh, I'm just an LP throwing 50K at this and I've got a $3 million net worth. Who cares? I
yeah,
mean, especially if it was directly owned, I would just be all about the downside, you
yeah.
know?
Yeah. I had a client. I was introduced. She was a widower. She inherited. Her husband had a couple apartment buildings. They weren't worth a lot of money, and she hired a broker. She sold it. She was doing a 1031 exchange, and he kept giving her properties. And finally, I was uh, introduced from her estate planning attorney. And I started asking different questions. I said, where do you want to travel? You're here, do you have, where do your friends live? And all of a sudden she said, oh, my best friend's in Charlotte. And I go, you should buy properties in Charlotte. Now you
Oh,
can
it's a great
fly to
market too.
Charlotte. Yeah, you can fly
Yeah.
to Charlotte and you can write off your trips and you can see your best friend. And guess what? You can ask her on a Sunday to drive by your property and just make sure that, you know, is it clean? Is the property being maintained? And I go, is that worth 1 point? Is that worth $100,000 in value? That's to me is worth so much money. And all of a sudden she looked at it and said, oh my God, yeah, you're telling me I can get $400,000 if I go to Idaho. I can get 350 in Charlotte, but there's so many more benefits going to Charlotte now. And she never thought about it that way. And I don't think a lot of brokers, and if you're listening, try to learn more
Fix it.
about the lifestyle of who your investor is. Try to make, because it's going to be easier to sell them a lifestyle also than just
Uh-huh.
here's another property to buy. So I'm
Well, because
always,
people aren't buying properties, they're buying outcomes.
yeah, yes. And if you can make the outcome even better just by saying, okay, if I got to replace a property, why not go someplace that you want to go instead of someplace you don't want to go just for a little bit more money? So it's, always look at it from just, it's not just how much cash flow you're getting is again, what the outcome will be. And sometimes the outcome is maximizing your quality of life as well. So,
I think another thing, if I were to give a tip to brokers, not that I am a broker, but I am in a sales role and have been my entire career, is that play the long game. Like business is an infinite game. You know, to define infinite game, it means that like you don't play two hands and you're done. You're like continuously playing hands. And that doing the right thing by the client and saying, okay, I'm going to let go of the down leg or up leg on this 1031 and I'm going to do the sale because it's the right thing to get this person into a property that is a more suited to their investment goals than I am capable of trying to close. Or okay, yeah, you'll get a referral, so you're not going to get the whole
yeah,
commission, but you're still going to get some. I would argue, especially in a broker where you like brokers exist in a submarket. Like that's how they go. They did like you aren't JLL. You're not like doing deals all around the country. You have a small community that you serve, and especially the real estate investment community in a given city is very small, and everybody knows each other. And that if you do right by that client and do the right thing for them, you will make more money. It'll be
yes,
over the long run, but you will make more money. And that is also why I'm speaking through brokers to every single other like person that sells a service in the world,
Well,
including myself.
when I was even doing, the private financing, and that a lot of clients would call me up and I would say, I can do the loan. You know what my terms are, but I'll take a gamble that I think this particular lender for this deal is the right lender you should go with for these reasons. But I want you to remember that I made the introduction, and I'm hoping you won't go to them the next time, but the next deal you have isn't going to work for them. And I've then made introductions and got a referral fee. But my client then said, I'm, he felt more I was his partner in the deal
Yes.
because I was looking out for him, and it wasn't me just saying, "Oh, yeah, let's close the deal at 9%
Yeah.
interest and
Cash
two
the check.
point." Yeah, and whereas I knew that there was somebody else who was really hungry at the time and would do a great job and give them the best financing for that particular project because it was definitely their wheelhouse, and it worked because the other lender was so thankful that and then my client, he came back and did lots of loans. And it was just realizing that I'm looking out for their interests.
Well, and hopefully also gave you some referrals to his friends because you treated
Yeah.
him so well and you were so
Yeah.
trustworthy.
Well, that helps too. Yes. And the
Yeah,
other
exactly.
lesson I would say is sometimes if it's outside your lane is be able to say no and
Oh, for
don't
sure.
like, yes, and so many people just end up trying to make a deal happen and then they get swallowed up in it and you don't look good to your client, whether you're trying to, sell a property or buy a property or financing, is really know your own limitations better than anybody else and know when no, this isn't the right opportunity for me to represent you.
And I think you're doing yourself a favor, not just because of your reputation. I think you're also doing yourself a favor because when you do deals or take jobs or service contracts that are outside your wheelhouse and you don't know what you're doing, your return on your time is going to just plummet
Yeah.
because you don't know what you're doing. You're not good at it. That means that everything is a freaking fire drill. The client's mad. Uh, the work product is substandard and you're not proud of it. And it was like a bad idea. And that's unfortunately one of those things where there are like life cycles of businesses. And that if you have, when you're first starting your business, your ideal client profile is everyone with a pulse, because like you need money. But like as quickly as possible, you need to start having the discipline to like know what you're good at and what you're not.
Yeah.
And that like, because that $2,000, I'm talking really low numbers, but like
Yeah.
that $3,000 a month client that is the job you shouldn't have taken is going to end up with like half your brain power, even though it's only a quarter of your revenue. Or, you know what I mean? And just be like a nightmare and you shouldn't have taken the deal.
Yeah.
Or if you get red flags from customers where you know that they're like, oh, I've had like, for some reason, I've had 5 brokers and they're all terrible and you're going to be the one that works.
Yeah. Yeah.
Say no to that client too.
Yeah. And, it's interesting is just as when I first started doing the private lending, I was introduced to a developer, met with his broker and with another mortgage broker. I'm looking at it and I'm doing my little numbers and all that. And I go, I can't do the loan. He goes, well, why not? I go, well, you're overpaying for the property. And he goes, well, what are you talking about? And I walked him through. I said, here's what you say your rents are going to be. So let's capitalize that. You're figure out what your income is. Here's your costs. Now let's do a land residual. And I said, and all of a sudden he looks at it and he said, oh, now I can find a lender who will look at it. He went back and ran his numbers and realized he was going to lose money on the deal. So I said, no. He came back and said, okay, I actually canceled escrow. Will you look at this property? And I said, yes.
Well, now you have the first look on every single deal that guy ever does for the rest of his career.
Yes, because I told him no and told him why and could back up the reason no. But it's like, understand, sometimes it's like you got to just tell somebody this is a bad deal and why. But if you don't have the why, then just can't say it's a bad deal. But, it was pretty obvious he was just overpaying. But he expected me to say yes because I'm,
Well, you were going to get paid. Yeah, it gets
I'm
your
gonna get paid.
origination.
Yeah.
Yeah. So I would bring that back to capital raising as well.
Yes.
I think one of the biggest sensitivities with capital raising, especially if you're doing private small investments like we talk about on this show, is that if someone is going to be in a lot of trouble if the investment goes to zero, or if they start asking a lot of terms about liquidity, you should probably tell the person that the investment is not right for them.
Yeah.
And I will tell you, the majority of the time they will invest with you anyways. But at a minimum, I mean, because you earn their trust by saying that, but that I firmly believe, like I said, if someone has a liquidity, like major concerns around liquidity, they do not belong in alts. If someone has major issues with like, hey, this is a lot of money for me, and if there's a problem with this, it's going to be an enormous problem, that person should also not be in alts. Alts are very high risk. And that even if they do close win, and you, sorry to use sales slang, even if they do end up investing with you, at the very least, you have on record that you had a very serious conversation about, is this investment right for you?
Yeah.
I will also tell you that virtually every time I've had that conversation, the person has invested.
Yeah.
And I was not trying to trick them or Jedi mind trick them. I was just saying, like, this is what this investment is. I'm not going to promise you or tell you that it's something else.
Yeah, and I think that's the sad part, is when you're trying to raise them money. I mean, I work with some what I call small syndicators. I'm helping them put together their pitch book and, to go to help them capital raise. And the one thing they want to do is try to be something to everybody. And I go, look,
Yeah, close every check.
But you're a fix and flip operator. You've been doing 4 or 5 homes a year. And you see there's a market and you could probably do 10, but you just don't have the capital. So you now want to do a $5 million, which is great. And your investors should do very well. But you have to tell each one, don't take somebody's money if you can't deliver what their expectations are. Because the next thing you know, you're going to be them buying that one home that you maybe shouldn't have, or that one deal. And that's the problem that I see with a lot of people is, you raise the money and now if you haven't identified the property, are you now trying to figure out what is that property I got to make good for my investors? So I think you got to stay true to yourself and say, this is the lane. I know this is what's going to work. And that's what you tell your investors. And I always believe under promise, over deliver. You tell somebody, my goal is to get, if a 10, 12% return isn't good for you, then I don't want to take on the additional risk to get your money. That's because I'm not going to be able to sleep well at night. But if you're comfortable at getting those 18 to 20 because you 8% returns because you've been doing it for 5 years, then it's comfortable to go out and say, hey, I'm offering 18 to 20%, and here's why, and here's my track record. But I think people, when they're trying to go to that next deal, they're trying to overpromise.
So, Bruce, this has been great. We're coming up on almost an hour, which is unbelievable. It felt like 20 minutes. So let's leave with, this is a capital raising show. Give me one of your biggest tips for capital raisers right now.
Okay. Aligning investor expectations with the realities of the deal structure. Sometimes you're feeling a pressure to secure capital within a specific acquisition window. And while your investors who you're talking to are going to need more time for diligence, underwriting who you are. So to me, the best thing that you can do to help raise capital is make sure you really have a great marketing capability of who you are. Make sure everybody understands what your track record is. And if you can give a specific, property that you're looking to identify. So it's like, be very specific. This is what my goals are. I want to buy this type of property, this size and be very specific. Because so many people I hear who are raising money are not specific enough. And then they lose a lot of investors because they're saying, I don't know if I can invest in the future if I don't know what the present is. If you understand what I'm trying to get at, is,
yes.
You've got to be able to, you got to match the risks that your investors are seeing versus what the realities of the market is right now. And I think people just do not see that at all. And,
Yeah.
so they're trying to manage their expectations improperly. And you got to be able to give
And I
them
think,
plenty of time to
yeah.
underwrite you more than what you're telling them you're going to be buying. And I think people underestimate what that involves in,
Yeah.
putting
And I
your,
think another undertone there is like, get good at a certain thing, get known with your investors and prospective investors of doing a certain type of deal over and
yeah,
over again. And that makes it so much easier to do this pre-selling,
yes,
where you're saying, hey, my deals all look like this. And
yep,
that makes it when it comes time to like show the deal and you've got to close in 90 days because you're under contract. If that deal is exactly what you told your investors is the type of deals you do, and it totally matches the track record that you have over 5 and 10 years of properly executing on deals that look like this, you're going to have a dramatically easier time. And
yeah.
so with that said, Bruce, how can people find you if they want to know more? How can you help the people on this show?
Well, you could reach out to me through LinkedIn. My profile's there. If anybody wants, just say, "Hey, I was saw you and want to get to know more." And obviously, you should be talking to Richard because he's going to be able to tell you how to make money, raising money.
Oh, hell yeah. All right. Thanks, Bruce. And as a
Thank
reminder
you.
to everybody, do not be the one who misses out. The Best Ever Conference is celebrating 10 years, and this year is bigger than ever. Deals get done and partnerships are made. I will be giving my What's Working in Capital Raising in 2026 workshop on day one for VIP ticket holders. There's going to be exclusive networking, and yes, you can hang out with me and all the Best Ever podcast hosts in person. Seats are going fast, and once we are sold out, that's it. No waiting list, no last calls. Grab your tickets now at besteverconference.com and use the discount code podcast10, all caps at checkout for 10% off. See you later, Bruce, and see
See you
everybody
later.
next Monday.
Happy Thanksgiving too, everybody.
Happy Thanksgiving, everybody.
Yeah. Thank you.